Welcome to Iron Financial. Our mission here is simple. We cut through the market noise, we ignore the hype, and we stress test the biggest stories out there so you can forge a stronger, more durable portfolio. And today, oh man, we're turning our hammer to a company that's been making waves for all the wrong reasons. Norwegian Cruise Line Holdings, ticker NCLH. They just reported earnings, and the market's reaction, well, it was brutal. Exactly. So we're going to break down the entire structure of this company's financials piece by piece to see if it's actually built to last, or if there are some serious cracks in the armor that you need to see. Let's get right into it. All right, let's just lay out the core facts on the table. On March 2nd, Norwegian reported its fourth quarter earnings. Now, if you just glanced at the headlines, on the surface, the numbers looked pretty solid. They actually beat analyst expectations on both revenue and on earnings per share. Normally, that's the kind of thing you'd expect a nice pop in the stock price for, right? A reward for outperforming. But that is not at all what happened here. The stock took an absolute nosedive. The market punished the company, and in doing so, it sent a very clear signal of disapproval. And that right there, that's the disconnect we need to get to the bottom of. You know, whenever the numbers are telling you one thing, but the price action is telling you the complete opposite, that's our cue to start digging deep. That's it exactly. See, the easy thing to do is to just read that headline, see the word beat, and assume, hey, everything's fine. But the price action, the movement of the stock, it's telling a completely different story. It's practically screaming that there's a problem somewhere under the surface. So the crucial question for us, the question that's going to define this entire analysis, is this one. What is the market seeing that the headlines completely missed? Is there some kind of deep structural weakness that the smart money is sprinting away from? Or is this just a massive overreaction, maybe creating an opportunity for those of us willing to look a little closer? To answer that, we're going to put NCLH through our rigorous 5-point stress test. First, we're going to define this post-earnings paradox. Second, I'm going to build the strongest possible bull case using the company's very own architectural blueprint. And then I get to try and tear it all down. Third, we'll unleash the bear case, and we'll start looking for all the cracks in that shiny foundation. Fourth, we're going to get our hands dirty and really stress test the balance sheet itself. And finally, we will deliver our verdict on whether this is a voyage actually worth taking for your portfolio. Let's get to work. Okay, section 1, the paradox itself. And let's be crystal clear about this. Norwegian delivered an earnings report that, by most traditional measures, absolutely surpassed expectations. Their revenue and their earnings per share were better than what Wall Street had modeled out. So this really should have been a great day for them. It should have been a signal that the big post-pandemic recovery is locked in and humming along. But the market's reaction was immediate, and it was punishing. This wasn't some minor dip. This was a loud and clear statement of no confidence from investors. And we have to figure out why. Right. I mean, at the end of the day, price is truth. The collective judgment of thousands upon thousands of investors, all voting with billions of dollars, decided that despite the earnings beat, the future for this company actually looks worse, not better. That price drop is such a critical piece of data. It is not just noise. It's a signal that there's a perceived risk that completely outweighs the reported results. So our job here isn't to argue with the market. Our job is to understand why the market is so concerned. We need to decipher that signal. And to do that properly, we have to start by giving the bull case its fair shake. Before we can start poking holes and finding flaws, we have to understand the architectural blueprint that NCLH management actually presented to investors. We need to see the company through their eyes for a minute and really understand the story that they are selling. Yeah, and it's an ambitious story, that's for sure. It's one of massive growth and a spectacular recovery. So let's see you build this bull case brick by brick. Let's see what they've got. This number right here, this is the absolute cornerstone of the entire bull thesis. Management has put a stake in the ground, and they are targeting an adjusted earnings per share, that's their profit per share after you back out certain one-time adjustments, of approximately $2.45 by the year 2026. Now, the critical thing to understand here is the incredible growth that this implies. To get from where they are today to that number requires a compound annual growth rate of over 30%. That is an absolutely explosive level of growth. If, and it's a big if, but if they achieve this, it completely changes the valuation profile of the company. It's an aggressive, very bold promise. And this slide, this is taken directly from their investor presentation. This is their blueprint. They call it their clear path. Just look at the trajectory here. Adjusted EBITDA, which is a key measure of profitability before interest, taxes, and other expenses, is projected to climb all the way to around 39%. Adjusted EPS, as we just saw, is set for that massive leap. And look right here, net leverage, which is their debt level, is projected to fall sharply, while adjusted ROIC, the return on their investments, is set to rise. This chart, it tells a story of a company just firing on all cylinders. This is the perfect picture that management wants you to see. It almost looks too perfect. It's just a straight line up and to the right on literally everything that matters. Kind of makes you wonder. Let's drill down on one of those key pillars right now, margin expansion. The company is projecting their adjusted EBITDA margin will expand by over 800 basis points to nearly 39% by 2026. Now, this isn't just about growth. This is about highly profitable growth. The narrative here is that they are on a clear path back to their pre-pandemic strength, recapturing that high margin profile that made this entire industry so attractive to investors in the first place. This right here is the engine that's supposed to power that massive EPS growth we were just talking about. But here it is. This is the most critical piece of the entire bull case. This is the heavy lifting. The single biggest risk for this company, the elephant in the room, is its absolute mountain of debt. And this slide shows their plan to tackle it head on. They project a reduction in net leverage from a dangerously high 7.3 times down to the mid-4 times range by 2026. This is the de-risking story. Every single turndown on this chart represents billions of dollars in debt being managed, which reduces interest payments and strengthens the entire balance sheet. For a bull, this is everything. If they can execute this deleveraging plan, they fundamentally transform the company from a high-risk liability into a cash-flowing asset. And look, it's not just the company that's selling this story. Wall Street analysts, for the most part, seem to be buying it. The consensus target price, according to Guru Focus, is over $27, which suggests pretty significant upside from where it is today. The recommendation is a moderate buy. So the bull case, you have to admit, it has some external validation. Okay. The plan is ambitious, I'll give you that. The numbers look impressive on paper, and the analysts see the potential. But what are they missing? Okay, that's a beautiful blueprint. I'll give you that. A clear path, strong targets, Wall Street is on board. It sounds absolutely perfect. But you know what? A blueprint is completely worthless if the foundation is built on sand. The entire bull case you just laid out, every single piece of it, is based on flawless execution and a cooperative economy. Well, every forecast has assumptions baked in. But we don't build portfolios for smooth rides. We build them for storms. It's time to stop admiring the architecture and start stress testing the foundation. Let's go looking for the cracks. And here it is, the first major crack. The reason the stock fell wasn't because of the past. It was because of their outlook for the future. They beat Q4, yes, but their forward guidance for the upcoming year, it just wasn't strong enough. In this market, with this level of debt, investors don't want to see good enough. They need to be absolutely blown away. When NCLH delivered guidance that was merely okay, the market interpreted it as a sign of weakness. A clear signal that their so-called clear path might have a few potholes they're not talking about. Now let's move away from sentiment and into a hard quantitative stress test, the Altman Z-score. It's a tool that was developed specifically to predict the likelihood of bankruptcy. It's been a trusted indicator for decades. The scoring is pretty simple. Anything above 3.0 is considered safe, but anything below 1.8 puts a company squarely in the distress zone, and that signals a tangible risk of insolvency within the next 2 years. Are you ready for this number? Norwegian's score is 0.41. Just let that sink in for a second. This isn't just in the distress zone, it is deep, deep in the distress zone. This is a 5-alarm fire from a financial health perspective. A score this low indicates that the beautiful deleveraging plan we just saw isn't just a goal, it's an absolute necessity for sheer survival. The market sees this number and it understands that the margin for error here is razor thin. This is exactly the kind of foundational weakness that can bring the whole structure crashing down. That is a brutal number. There is absolutely no way to spin that. So, if the quantitative models are flashing bright red, what are the insiders, the people who know the company better than anyone? What are they doing? Are they buying up shares at these suppressed prices? No. In the last 3 months, there have been 0 insider buys, but there have been sales. Now, look, 5,250 shares isn't a massive amount, but the direction is what matters. The people with the most information are not stepping up to buy the dip. And that begs the question, if the executive team isn't confidently buying their own stock at these prices, why should you? Okay, the Altman Z-score and the insider activity are, without a doubt, serious red flags. I will concede that. Those risks are significant.
But to truly assess the structural integrity here, we have to go beyond just the summary scores and look at the raw numbers right there on the balance sheet. Let's put the key ratios on the table and see exactly where the pressure points are. All right, let's look at liquidity first. The current ratio, which measures their ability to pay their short-term bills, is at 0.19. The quick ratio, which is an even stricter test because it excludes things like inventory, is at 0.17. Let me translate that. A healthy ratio for these is 1.0 or higher. At 0.19, it means that for every single dollar of debt they owe in the next year, they have only 19 cents of current assets available to cover it. This is what we call walking a financial tightrope, without a net. It indicates extreme liquidity challenges. And on top of all of that, a beta of 2.39 means a stock is more than twice as volatile as the overall market. So this is absolutely not for the faint of heart. And there's another point of failure right here. Even if we ignore the massive debt for just a second, their core operations are weak. An operating margin of 15.7% is considered inadequate for this kind of business. It points to a suboptimal cost structure. What it means is that even before they pay the massive interest on their debt, the core business itself isn't generating the level of profit that it really should be. So this isn't just a balance sheet problem, it's an operational one too. Okay, we have now seen both sides of the coin. We've examined the bull's ambitious blueprint for growth and for deleveraging, and we've run the bear's absolutely brutal stress test, which has revealed some deep, deep cracks in the financial foundation. So it's time to bring this to a head. We need to weigh the potential rewards against the very real risks that we've uncovered and arrive at a final verdict. So when you boil it all down, the entire bull case really comes down to one single word: execution. If management can perfectly execute their plan, if they hit that $2.45 EPS target and they bring that net leverage down, then the stock is very likely undervalued today. The high institutional ownership shows that a lot of big money is betting on exactly this turnaround. But that is a huge if. And the bear case is grounded in the brutal reality of the present. The massive debt load is like a sword hanging over this company's head. Any hiccup, a mild recession, a spike in fuel costs, it could be catastrophic. The severe liquidity risk, with that current ratio of 0.19, it means they have zero cushion. They are completely and totally exposed. It's a classic high-risk, high-reward turnaround play. I'd call it a high-risk, potential ruin play. The weak guidance and the complete lack of insider buying suggests that even the people in charge aren't screamingly confident. For a conservative portfolio, the risk of permanent capital loss here is simply too high to ignore. Ultimately, this investment case really hinges on two completely different futures. The bull path requires smooth sailing. It needs a strong economy, it needs resilient consumer spending, and it needs perfect operational execution from management. If they get all of that, the stock could sail to much, much higher valuations as the company de-risks and grows earnings. But the bear path, that's one of stormy seas. A recession, persistently high interest rates, or any significant operational misstep could completely capsize this company. Their weak balance sheet gives them no ballast to ride out a storm. One of these two paths is going to play out, and the determining factors are largely outside of the company's full control. And that brings us right back to the core mission of Iron Financial. Our goal here was not to predict which path NCLH will take. We don't have a crystal ball. Our goal was to stress test the company's current financial structure so we can all understand its durability. You see, a strong portfolio isn't built on best-case scenarios. It's forged to withstand worst-case scenarios. This entire analysis is about identifying the risks that could permanently impair your capital. So we're left with the final, crucial question. Has Norwegian Cruise Line actually laid the foundation for a financial fortress with a clear blueprint to rebuild its strength? Or is its beautiful growth plan just a house of cards, poised to be blown over by the first economic hurricane that comes along? The data we've looked at presents a pretty compelling case for both sides, and how you answer that question for yourself will determine whether this stock becomes a powerful engine for your portfolio or the anchor that sinks it. Think carefully.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.